Right, Chapter 9, Unit 3, Forms of Ownership. Today we're going to talk about close corporations. Right, so nature of a close corporation. Just before I start with this one, it's very important to know that you can't register any new close corporations in South Africa. It has been replaced with different types of companies. In other words, you get profit companies, non-profit, but in any case, the purpose of close corporation is not needed anymore. It is fulfilled with companies. Right, so in a close corporation, you get 1 to 10 members. It is a very practical, easy way of setting up a business, a legal entity in itself, and members make all of the financial and strategic decisions. Right, so business expenses are separate from those of members, less risk for members. It means that the business is seen as a separate legal entity. That means it has its own bank account. In other words, if it makes a loss, the close corporation will have to cover it, not you as an individual. Right, so ends with letter CC, for example, Smith Consulting CC for close corporation. According to the Close Corporation Act 69 of 1984, needs to be registered with the Register of Companies. Right, so it receives a unique registration number. Business exists until closed down. Financial and business decisions are shared amongst members. And then advantages, right? So has its own legal identity, trading name, and owns its own assets. Members can have unequal distribution of shares, referred to as percentage member interest, how they would like to contribute. So if you only have enough capital to buy or have 10% of this cooperation or close corporation, then you will have 10% shares. Members more prepared to take risk, not legally implicated, known as limited liability. This means that if the company makes a loss or if they go bankrupt, the bank will only go after the assets of the close corporation and not after your personal assets. Members receive profits according to percentage membership interest they hold. So if you receive or hold 10% interest, you will earn 10% profit. Possibility to buy out interest of other members, which makes it less of a concern if a member dies, gets bored, or goes bankrupt. If that is the case, then amongst the members they can divide that percentage and buy that member that passed away, or whatever the case, they can buy shares or her shares. Different members are able to contribute different management and decision-making skills to the business, because everyone has different skills and knowledge. If more capital is needed, loans can be approved by members. Although registration fees and paperwork, a close corporation is not expensive as formation of other companies, but you need to register. It's not applicable anymore. No requirements for an audit, financial statements, simple management structure, and members full in control. And then disadvantages. Amount of capital limited, the maximum of only 10 members. So in other words, if you have 10 members and you need more capital, it's going to be hard to get more capital since you can't get more members. They can't buy into it. But if you have 8, then you still have the possibility of 2 more members. Members required to pay a personal tax on salaries regardless of profit. So the closed corporation will pay tax on profits, and then the members will receive a salary from the closed corporation on which they also will have to pay tax, known as pay as you earn. Company tax has to be paid on the amount of profit the business makes, as I just explained. There may be more than one manager depending on number of members, and that can lead to conflict. And remember, where people work together, there's different ideas and different ways of doing stuff, and unfortunately, as a result, always a possibility for conflict. Each member is allowed to act on behalf of the closed corporation, decisions that is not agreed on by everyone. So one guy can make a decision and other people won't agree with him, but there's nothing to stop that member